I'm here with Ferdisha Snagg, partner at Cleary Gottlieb Steen Hamilton, and also the chair of our Global Regulatory Updates panel. You were actually fantastic, by the way. I loved your panel discussion. It was very conversational. So thank you for doing this interview with me. I'm just going to jump straight in.
Yeah, absolutely. And no, but just to say thank you for having me. I absolutely enjoyed chairing the panel as well this morning. I thought the panelists were great, a variety of perspectives. And this conference is really great, actually. A lot of energy in the room. So well done for, organizing it. It's a really great event. Yeah.
Okay, so do you think stablecoins should be regulated differently to other crypto assets?
Yes, I think that's right. And I think that's borne out by the fact that regulatory frameworks do tend to make that distinction. And that is because certainly fiat-backed stablecoins that can be used as a means of payment, they have a real potential of becoming systemic, basically. If they become very widely used as a means of payment, especially for retail customers to make day-to-day payments, then you can see why the regulators want to focus on that. Because you can contrast stablecoins to sort of, the more unbacked crypto assets like Bitcoin, like ETH, which were maybe traditionally called virtual currencies. Mm-hmm. They absolutely cannot be used as a stable kind of means of payment, as a store of value, because the price it's so volatile, basically.
Yeah.
So they do not necessarily hold on to that value. That means that they can be used as a unit of account and therefore as almost like money, basically. Mm-hmm. But stablecoins really have that potential. And it also is tricky as well. The regulators have to think about that because that is probably primarily the use case of these fiat-backed stablecoins, the payments use case. But of course, some people may want to invest as well and hold it as an investment. And the regulators have, tended to try to limit that by saying actually they're not an investment, so you're not meant to pay yield, etc.
Yeah.
It really should be used almost like money, basically, and so should be treated as a normal payment instrument. And I think that is what justifies seeing stable coins as different, basically, because they perhaps have the greatest financial stability risk just because of how widely they can be used in kind of everyday life.
Yeah, it's so interesting. So why is agreeing on a definition of a crypto asset so difficult? Because I did notice you said that you're obsessed with definitions in your panel.
Thankfully, exactly. I think all of us are, because that's just the nature of regulatory practice. And it is difficult, actually. If you're a policymaker, you want to capture as many things as possible, basically. And so, regulations tend to go for a very tech-neutral definition, a very neutral, not just even tech neutral, but a very neutral definition. So if I think of how the UK legislation defines crypto assets, it's something like cryptographically secured digital representation of value that can be traded, stored, transferred, etc., using technology like blockchain technology. That's kind of a summary of the definition. And that captures all sorts of things, basically, right? If you think of what that could capture, what if you cryptographically secure on a blockchain a spreadsheet? If that's suddenly a crypto asset. But that is the starting point that regulators have to adopt, because in general, regulators strive to take the philosophy of same risk, same regulation.
Yeah.
Or in the UK, we say same risk, same regulatory outcome. It means that if your new kind of product looks very much like something else and poses similar risks, then you should regulate it like the something else, basically.
Yeah.
So you do want to capture a broad range of things that can fit within, the use case, and that can actually look like other things. And then you have to drill down, and that's where the drilling down could be challenging, basically, because you tokenize something doesn't necessarily mean you change what it is. Basically, it could actually be a traditional asset, really, and the blockchain shouldn't really matter. You should regulate it like a traditional asset, and maybe some bells and whistles, to reflect the fact that there's a crypto element, but really it should look like how you regulate the other thing. So an example of that would be like a tokenized security. Primarily a security, because you tokenize it doesn't mean it's not a security, but you probably have to reflect a little bit that, there will be operational differences in the way people hold, trade, etc. So it's really a real challenge, actually, to work out the art of the possible, what you can capture within a broad definition, which is what you need. And then how do you distinguish between different products, basically? And a lot of that comes to the use that people are making of the different products, basically. And I think sometimes it could be difficult for policymakers to really understand that, basically. So, for example, if I think of, the UK journey, the UK passed legislation earlier this year to regulate crypto assets, including qualifying stablecoins. And they decided, well, we're just going to put it into the traditional financial services framework, basically. So going with that same risk, same regulatory outcome kind of approach. But they got feedback very quickly that they needed to change the legislation, because by regulating in the way that they were regulating it, they were introducing kind of, barriers to entry and sort of competition issues basically in the market. And it could be really disruptive. And so it was a sort of exercise in having to go back to the drawing board and think again about how to get the exact right policy.
There's a lot to think about.
Yes.
Definitely.
Yes.
Okay, so last one. If you could just give me one misconception policymakers still have about digital assets.
Well, actually, I'm not sure it's fair to qualify it as a misconception, but it is really that being wedded to the idea of same risk, same regulatory outcome. Because I think in that, with that approach, I think it's the right starting point. But what you can miss in that is that the markets, and there's a lot of retail participation in these various markets, might have a different view as to what it is that they hold.
Yeah.
So a regulator will say, this looks like something else.
Yeah.
And this is how I should regulate that. But, to the person on the street who might invest in Bitcoin or stable coins, etc., they see it very differently, basically. And not recognizing that, I think, could be a real challenge. I think that's why DeFi will continue to be a very difficult area, because there will be huge sections of the market that thinks you should recognize decentralization. It should be different from the traditional intermediated markets. But the regulator will be very reluctant to kind of buy into that because they think, well, this looks like something else that we already regulated. And surely there's nothing called a truly decentralized model. But you're going to get that kind of misunderstanding, I guess, or misalignment between actual users and, regulatory policy. The regulatory policy will keep having to catch up.
Thank you. That's been very informative.
No, thank you very much.
Thank you.
Thank you very much. I really, really appreciated being here. Thank you.